Right now, as you're watching this, something extraordinary is happening beneath the surface of the global financial system, and the mainstream media is barely whispering a word about it. Silver, the most undervalued, most manipulated, most industrial metal on planet Earth, is standing at the edge of a historic breakout that could completely transform the wealth of anyone paying attention today. And I need you to pay attention because the data I'm about to share with you is not opinion, it's not speculation, it's cold, hard, documented fact. So take notes, stay with me, because what I'm going to lay out for you in the next 20 minutes could be one of the most important financial conversations you ever have. Let's start with price reality, because that's always where we must begin with what's actually happening in the real world. Silver started 2025 at 29.29 an ounce. By mid-December 2025, it broke $64 an ounce. That is a 107% surge in a single year, one of the most dramatic precious metals rallies in modern history. The Silver Institute confirmed silver hit an all-time record high of 54.48 on October 17, 2025, eclipsing the 52% gain in gold and absolutely crushing the S&P 500's 14% return in the same period. And then silver kept going, pushing above $80 an ounce by early January 2026. Silver went from an ignored, overlooked stepchild of gold to the best performing major asset class on the planet. And here's what should alarm you. Most people still missed it. Most people are still sitting on the sidelines asking, is it too late? And the answer, when you understand what I'm about to show you, is absolutely not. Because this isn't just a price move driven by traders and speculators. This is a fundamental structural transformation in the supply and demand equation for silver that is now so deeply entrenched, so mathematically locked in, that even if every investor in the world sold their silver tomorrow, the industrial world alone would keep consuming far more of it than the mines can possibly produce. Let me explain exactly what I mean, because this is where it gets serious. The Silver Institute, this isn't some fringe newsletter. This is the authoritative body tracking global silver markets, has confirmed that the silver market is now entering its sixth consecutive year of structural supply deficit in 2026. 6 years in a row. Let that sink in. For 6 consecutive years, the world has consumed more silver than it has produced. The cumulative shortfall from 2021 through 2025 alone is estimated at over 820 million ounces. That is nearly equivalent to an entire year of global mine production wiped out, gone, consumed, and not coming back. In 2025 alone, global silver demand reached an estimated 1.24 billion ounces, while total supply from mines and recycling combined amounted to only about 1.01 billion ounces, leaving a deficit of over 230 million ounces. Think about that number, 230 million ounces. That is the equivalent of the total annual production of Mexico, the world's single largest silver producing nation, evaporated into thin air in just 1 year. And here is the brutal truth about silver mining that most people don't understand. Unlike gold, silver is largely a byproduct of mining copper, zinc, and lead. That means even if silver prices double or triple, miners cannot simply flip a switch and dramatically increase silver output, because their entire operation is driven by the economics of base metals. On top of that, new mining projects take 8 to 12 years to develop from discovery to production. Global ore grades are declining. Mine supply has actually shrunk by 7% since 2016, according to Sprott Asset Management. The Silver Institute confirms 2025 global mine silver supply remained essentially flat at around 813 million ounces, the same as prior years. There is no cavalry coming. There is no new supply rescue on the horizon. The math is the math, and the math is devastating for anyone betting silver prices go down. Now let's talk about where all that silver is actually going, because this is the part that changes everything. The part that makes silver's story in the 21st century fundamentally different from every silver bull market that came before it. Silver is no longer just a monetary metal, just a jewelry metal, just a coin that people stack in their basements. Silver is now a critical technology metal officially designated by the United States government as a critical mineral, a strategic resource essential to national security and economic survival. Think about what you use every single day. Your smartphone contains silver, your laptop contains silver, every EV you see on the road contains silver, every solar panel being installed, and China alone installed more solar panels in the first half of 2025 than the rest of the entire world combined. Every single one of those panels requires silver. The European Union has now mandated solar energy integration in new buildings starting in 2026. Saudi Arabia is constructing massive solar farms targeting 50% of domestic electricity from renewables by 2030. AI data centers are consuming silver and high-efficiency electrical components and thermal management systems at a pace that is accelerating, not decelerating. According to Sprott, industrial demand now accounts for 59% of all silver usage. This isn't a commodity story. This is a civilization story. And civilization is running on silver. And then there's India, the sleeping giant that has awakened. India became the world's largest importer of refined silver in 2025, with imports estimated at $9.2 billion for the year alone, a 44% increase over 2024, despite the fact that prices had nearly tripled domestically. Silver prices in India surged from around 80,000 P5,000 rupees per kilogram in early 2025 to above 2.43 lakh rupees per kilogram by January 2026. And Indian buyers kept buying. They bought more. Higher prices didn't kill demand. They accelerated it. Because Indian investors, Indian industry, Indian culture understand silver in a way that Western investors are only just beginning to rediscover. And that demand from India, combined with surging investment demand from ETFs that absorbed 134 million ounces of physical silver in 2025 alone, pulling that metal out of the market and into vaults, is creating a physical tightness that is now impossible to hide. Let me show you what that physical tightness looks like in the real world, because this is where the story goes from concerning to urgent. The London Bullion Market Association, the physical hub for global silver trading, has been hemorrhaging metal. In June 2022, the LBMA held 31,023 metric tons of silver in its vaults. By March 2025, that number had fallen to just 22,126 metric tons, a reduction of nearly a third, hitting its lowest point in years. Goldman Sachs confirmed that the London liquidity crunch became so severe in early 2025 that large volumes, tens of millions of ounces, were physically transported from London to COMEX vaults in New York in response to tariff fears. Some market participants had to ship silver by plane rather than cargo ships just to meet delivery demand. Let me say that again, shipping silver by airplane because supply chains couldn't move it fast enough. That is not a normal market. That is a market under extreme physical stress. COMEX registered silver inventories in the United States are down nearly 70% since 2020. Shanghai inventories have fallen to their lowest level in a decade. At current consumption rates, some industrial regions have barely 30 to 45 days of accessible silver reserves, 30 to 45 days. And the lease rates, for those of you who understand what lease rates tell us about physical market stress, silver 1-month lease rates, which in normal times sit around 0.3%, 0.5%, exploded to around 8% by January 2026. 8% annualized lease rates for silver, that is the market screaming at you that physical silver is extraordinarily difficult to source. When someone is willing to pay 8% just to borrow silver, To ensure delivery, the physical supply-demand balance is not just tight, it is severely, critically out of alignment. And confirming that signal, the silver futures curve moved into backwardation in late 2025, meaning silver you can take delivery of right now was priced higher than silver promised in future months. Backwardation in precious metals is a once-in-a-generation event that signals one thing clearly: the market doesn't trust that future supply will be available. The physical market and the paper market are beginning to diverge, and history tells us that when they diverge, the physical reality wins every single time. Now let's bring in what the most respected financial institutions in the world are saying, and pay attention, because when JP Morgan, Citigroup, BNP Paribas, Bank of America, and UBS are all sounding the same alarm, this is not fringe analysis. JP King Global Research has stated it sees silver prices averaging $81 per ounce in 2026, more than double silver's 2025 average. Citigroup predicts silver will continue to outperform gold and reach upwards of $70 for 2026. Bank of America raised its 12-month silver target to $65, and UBS lifted its mid-2026 target to $55, citing ETF inflows and fiscal imbalances. BNP Paribas suggested silver could reach $100 per ounce by the end of 2026. And on the more bullish end, analysts from Allegiance Gold have issued forecasts of between $100 and $144 per troy ounce near term. The De Beer Group made headlines with a projection of $200 per ounce. First Majestic Silver CEO Keith Neumeyer, one of the most experienced silver miners in the world, has called $100 silver nearly inevitable. And Ned Naylor Leland at Jupiter Asset Management told CNBC investors should assume silver will break triple digits. 57% of retail investors in the Kitco News 2026 survey expect silver to trade above $100 an ounce this year. The consensus is building, and it is building fast. But I want to talk to you about something even deeper than price targets, because price targets can be wrong. The money can print, the economy can lurch, markets can do unexpected things. What cannot be wrong is mathematics. And mathematically, let's look at where silver sits in relation to gold right now, because the gold-silver ratio is one of the most reliable long-term valuation tools we have. Historically, the gold-silver ratio, meaning how many ounces of silver it takes to buy 1 ounce of gold, has averaged around 67 to 1 over the long term. In April 2025, that ratio exploded above 107 to 1, one of the highest readings ever recorded in history, meaning silver was extraordinarily cheap relative to gold. By October 2025, it had compressed back towards 78 to 1 as silver's bull run accelerated. What does that compression tell you? It tells you capital was flowing aggressively into silver, recognizing a once-in-a-generation valuation discrepancy, and with gold now trading above $5,000 an ounce, even a return to the historical 67 to 1 ratio would put silver north of $74 an ounce. A reversion to the historical mean of 15 to 1, which is the geological ratio at which silver and gold exist in the Earth's crust, would imply silver at over $300 an ounce. I am not telling you that's where we're going tomorrow. I am telling you that is what the historical and geological data says the natural equilibrium looks like. Now there is another piece of this puzzle that most analysts are not fully incorporating yet, and it relates to monetary policy, the Federal Reserve, and the global currency system. The U.S. dollar is under structural pressure. The U.S. government served the Federal Reserve with grand jury subpoenas in early January 2026, an unprecedented attack on Fed independence that is rattling institutional confidence in the dollar globally. Central banks around the world purchased record quantities of gold in 2024 and 2025 as they diversified away from the dollar. In what analysts have called a watershed moment, Russia has been executing a multi-year plan to accumulate $535 million in silver reserves, marking the first major central bank in modern history to openly add silver to its strategic reserves. This is not a coincidence. This is a signal. When sovereign nations begin accumulating silver as a monetary reserve asset, the game has fundamentally changed. Every currency crisis in history, every hyperinflation, every devaluation, every monetary reset has ended with hard assets reasserting their value. Silver has outlasted every paper currency system ever created, every single one. And as the world's fiat currency system faces its greatest stress test in generations, silver's dual role as both an industrial essential and a monetary safe haven creates an asymmetric opportunity that very few assets in human history have ever possessed simultaneously. Let me give you the full picture on supply one more time because I want this number to burn itself into your memory. The Silver Institute, not a blog, not a YouTube channel, the Silver Institute, the world's foremost silver market authority, projects a sixth consecutive deficit of approximately 67 million ounces in 2026. Including the 2025 deficit, the cumulative 5-year market shortfall will exceed 800 million ounces, nearly a full year of all global mining output. The Silver Institute's own language describing the conditions driving silver to record highs says those dynamics remain firmly in place: tight physical supply in London, a volatile geopolitical backdrop, U.S. policy uncertainty, concerns over Federal Reserve independence, and supply-demand fundamentals that are, in their own words, supportive. What they mean, what all of this data means, translated into plain language, is that the silver market is structurally broken on the supply side, and there is no immediate fix. There is no mine that opens tomorrow and saves the day. There is no recycling breakthrough that replaces 230 million missing ounces per year. The world needs silver more than ever, and the world is running out of easy silver. That is the reality. So what does this mean for you as an investor? It means that physical silver metal you can hold in your hand, metal that carries no counterparty risk, no credit risk, no promise from a bank or a government that could be broken. That physical silver is your most direct exposure to this story. Not a silver ETF where someone else holds the metal, not a paper futures contract that settles in cash. Physical silver, because when the paper promises and the physical reality diverge far enough, and the data suggests we are already deep into that divergence, it is the people who hold the physical metal who hold the real wealth. ETFs are absorbing hundreds of millions of ounces and locking them in vaults, making the physical available supply even tighter for everyone else. Mining stocks offer leveraged exposure, but carry operational and geopolitical risk. Dollar cost averaging into physical silver over time is the strategy most aligned with these long-term structural drivers, because you are not trying to time a volatile market, you are positioning yourself in alignment with mathematics, geology, and monetary history. Consider the numbers from the broader investment landscape. Sprott has documented that gold and silver have outperformed every other major asset class from 1999 through 2025, outperforming the S&P 500, outperforming bonds, outperforming almost everything over that full 26-year period. Silver delivered nearly 25% in the first half of 2025 before it exploded higher in the second half. It delivered 21% in 2024. And before you say I missed it, remember analysts at the beginning of 2025 had a consensus silver price forecast of just $32.86 an ounce for the year. Silver ended up above $60. The experts were wrong by 100%. The fundamentals were not wrong. The deficit was not wrong. The industrial demand was not wrong. The vault depletion was not wrong. Every structural driver that was documented was real, and the price followed. The same structural drivers are not only still present going into 2026, they are more intense, not less. The sixth and consecutive deficit is larger in context. The London vaults are thinner, the lease rates are higher, the global investment demand is broader. The Western physical investment demand is now forecast to rise 20% in 2026 to a three-year high of 227 million ounces as investors who sat on the sidelines in 2025 finally jump in. Here is the most important thing I want you to understand. The thing that separates those who protect and grow their wealth in times like this from those who don't. Silver is not a speculation. It is not a bet. It is not a gamble. Silver is a response to a system that is mathematically and structurally failing to supply enough of an indispensable resource to a world that needs it more every single day. Solar energy is not going away. Electric vehicles are not going away. AI data centers are not going away. 5G infrastructure is not going away. The green energy transition is global. It is policy mandated in dozens of countries simultaneously, and it requires silver that does not yet exist in sufficient quantities. That is not an opinion. That is the consensus of the Silver Institute, HSBC, Goldman Sachs, JP Morgan, Citigroup, Sprott, the CME Group, and analysts in every major financial capital on Earth. When all of them are pointing to the same structural reality, the wise investor listens. The window in which silver can be accumulated at prices still in the double digits may be closing faster than most people realize. Silver at $60, $70, $80 an ounce may look extraordinarily cheap in 3 years, the same way silver at $20 looks cheap today. History is on silver's side. Math is on silver's side. Industrial necessity is on silver's side. Monetary reality is on silver's side. The only question is whether you are going to act on that information before the crowd does, or whether you're going to be watching a future video wondering why you waited. The great silver squeeze of 2026 is not a theory. The vaults are emptying, the deficits are compounding, the demand is accelerating, and physical silver, real, tangible, in your hand silver, is the one asset that cannot be printed, cannot be created from nothing, and cannot be devalued by any central bank or any government on earth. That is its power. That has always been its power. And right now, that power is more relevant and more urgent than at any point in the last generation. Don't wait for permission. Don't wait for the headlines. The data is here. The data is now. What you do with it is entirely up to you.